Welcome to On the Edge, a show examining how deals actually happen in commercial real estate. Host Malcolm Davies, founder of Way Capital, speaks with professionals in development, investment, finance, and more for insights into how these business leaders get deals capitalized. Malcolm's career spans more than 20 years, during which time he has managed nearly $20 billion worth of financings. Now to your host, Malcolm.
Hey everyone, welcome to the next edition of On the Edge, how real estate deals actually get done. I'm extremely excited today to have one of my great personal friends, David Butler, who is the co-CEO of Argosy Real Estate Partners. Dave, welcome to On the Edge.
Very happy to be here. Thanks for the invite, Malcolm.
Well, cool. So, I always ask people this, but I guess where in the world are you today? Are you up in Northern California, traveling, or where are you?
Well, today you caught me. I'm in Northern California. I'm actually in my home office. It's on a Friday, so I'm excited to be home. I've actually not been home for almost 3 weeks. I was on vacation, which was great, and then I was in Europe on a fundraising trip, and then on the East Coast. So I'm just looking forward to being home for a while this summer. It's been a lot of travel this spring.
I think the one thing that most people don't realize how much travel it takes to actually get deals done. And I probably could do a whole episode on how much travel I think folks like yourself or myself are involved in. We see each other in every city or every place in the world. Yeah. So cool. Like I'm excited to introduce the audience to you guys. Maybe if you could just for a moment give a little brief background on who Argosy is, and then also, just kind of things that you're looking at doing, but also your personal background too. How did you get into commercial real estate as well?
Sure. So Argosy, we are a fund management firm focused on the lower middle market real estate investments, which we kind of define as the $5 to $30 million equity investment size. We're generally a controlling investor, kind of 50 to 90% owner, but we'll do, some participating pref equity and GP co-invest. But we invest through a series of funds, which are a combination of opportunistic funds. That's kind of our main flagship vehicles. And then we also have a Core Plus fund. We've done a lot in the opportunity zone space as well. And then we recently added about a year and a half ago a public securities business as well, which is a separately run company that's owned by us as well, partially owned by us, which is runs a long biased hedge fund vehicle focused on real estate and also some SMA accounts. So yeah, my partner Andy Stewart and I, we've been with Argosy now over 15 years. Argosy Capital is our parent company. They have separate verticals. They have a private equity business, kind of corporate private equity, credit, and secondaries. But Andy and I run the real estate group. We've grown the firm very substantially since we came in 2009, and we've grown it from very small kind of Southeast portfolio multifamily assets to a very diversified business with 10 different funds now that we manage, which are all fully discretionary, and we run right about $2 billion of equity AUM into about $3.5 billion of gross AUM.
And how did you start the platform, or how did it all get going, and what was your how did you get into this type of the market?
Sure. So I'll just start. So I started out actually in investment banking. Worked for a firm called Robertson Stephens out of undergrad, which was a San Francisco based, primarily tech investment oriented firm, but actually after I joined in 97, they were bought by Bank of America and then by Fleet and Bank Boston through various kind of M&A activities, and which were all big real estate lenders. So I actually moved over to the real estate group in those groups and covered the REIT market predominantly, raising money for REITs, doing M&A advisory work for REITs. Did that until 2002, and then went to business school, and then came out of business school, and I worked on the investment side. My first kind of direct investment job was with AIG and their global investment group based in San Francisco, and we were raising funds and also predominantly I was on the investment side, but also was kind of the COO of that office, and we grew pretty substantially. But that was JV investing, the local operators, developers in the U.S. and Mexico, but larger size deals. And then I went over to JP Morgan in 2005 in their San Francisco office and was doing very similar type investments, again, on the larger scale. And I'd always kind of wondered over the years, who was focused on these, sub, $30 million equity investments because they were too small for firms like us at that time. And
Sure.
And whether or not we could build a business around it and, real sustainable long-term business with doing smaller deals. And we were fortunate, Andy and I were both laid off from our respective jobs in 2008. And we really didn't have a lot of other options in the market employment-wise. So we decided to get entrepreneurial, and we were able to find Argosy, who, as I mentioned, had other verticals at that time, actually just one other vertical on the private equity side, but they were looking to expand more and kind of bring institutional capital to the real estate business. And the timing was good. It was hard to raise money in 2010 to 12, but we got our first few funds out of the ground and kind of was off to the races from there.
That's great. I always like to say that, our generation, you and I are the same age. The Gen Xers, we went through a lot there in the eras of the .com and 9/11 and the GFC. And so, in the first 10 years of us all working, it was a lot of things. We actually, it's great because it actually applies to today, of course. But, I think in general, one of the things I wanted to ask you about and knowing the kind of lower to middle market, equity investing. One of the reasons why you found that spot is that it's more difficult. It's you have to do more deals. You have to find the operators. You have to find the opportunities. How have you been able to navigate that marketplace? I think it's a massive market. Don't get me wrong. And so one of the reasons why we've done a lot of business together is that we both like the space. I like to work with entrepreneurial sponsors involved in, I like to call it institutional deals. I like to say that we run an investment banking approach to capital advisory, but at the end of the day, it's trying to find groups like Argosy to deploy capital. How have you made it efficient, or how do you look for those opportunities? And frankly, how do you find the sponsors?
Yeah, so our operating sponsor network, we've done investments with approximately 50 different operating partners around the U.S. Generally, we prefer our operators to be as focused as possible on either a certain asset class or a certain geography. So really, our team is very focused because our operating partner network is really kind of the extension of our network. We have a small investment team, and we're trying to find the best partners. We're obviously having an investment approach, kind of a top-down approach as to where we want to invest, which markets and which asset classes. But we also spend just as much time on those relationships, operating partner relationships, and trying to do obviously find the right partners, but then do repeat business with them. To your point earlier, how difficult the market is, it's to find all the operators and pull it all together. It helps a lot if we can do repeat business with those groups. So we can get long-term relationships is extremely helpful. It kind of helps the business run more efficiently from our end. But it is a very complex business. Andy and I joke, you got to know a lot about a lot. A lot of people say, oh, you know a little about a lot, or a lot about, like, you actually need to know a lot about a lot. And you have to have a very good team. You need to build the right culture. And we do the same thing with our operating partners. I mean, we spend a lot of time underwriting those groups, make sure they're the right, cultural fit, and that there's the proper alignment, as kind of, deal economics and incentives, and also how they can execute and, their capabilities. And we look back, it's been a while since the GFC, but, when we were kind of getting this going, you also kind of look back to see how those partners performed during the GFC, and, how they made it through the tough times, and did they stick it out, and did they do the right things, by their LPs. So it's a fascinating business. There's always something to learn, either a new asset class or a new market. And you have to be, like we mentioned earlier, you have to be visible. You have to be out in the market. You have to meet a lot of people, and you got to hire those people. Andy and I can't do it all ourselves anymore. You got to hire, a great team, which you've dealt with a lot of our team.
Sure.
You can extend that outward and get a lot of reach.
I think, one of the things that I find really amazing about both yourself and Andy is how out there you are. I think, part of the business, and one of the reasons why I put this podcast together is that, as much as it might be about the numbers or it might be about the economic structure of a deal, it really does come down to the relationship and the way that folks are with each other. It's how they communicate together. What are the, how do you deal with the tough challenges that, every real estate deal, I don't know, any real estate deal has gone exactly as planned, and you have to make sure that you can communicate. And so I find it amazing that you and Andy, for all the years that you'd be at all of the industry events that I was at, and I should be there because I'm the advisor, but you were always there. So from the outset that you guys were going to out hustle really some of your competitors and make sure that the folks that were the sponsors, they knew you individually. How did you think about that?
Yeah, I mean, I think that you have to build a reputation of, being in the flow, but also of, doing what you say you're going to do, right? You need to have integrity, and you need to be out there. And so part of the business too, if you're going to be, traveling so much and away from home, you want to be sure that you're spending time with good people too, right? I mean, our partners, again, are kind of an extension of our team. And so, being out there and being able to get the opportunity to meet, so many different people in different cities. I mean, it's great. I mean, I'm able to pretty much go into any city in the U.S. or a major city in the U.S. Either Andy or I, and we, have someone to have dinner with, either partner or broker. It is the ultimate kind of people business, real estate.
Yeah, it is. I always I'm fascinated by, look, we're leveraging technology, we're all using technology in a better way than we have before. But I think one of the things about commercial real estate is it is a generally very difficult business to really notice, one location to the other, the asset classes, who's involved in it. It's a challenging place, and that's why we have careers in it, because it takes a lot to get things to actually get done. Okay, so on that note, you have various investment thesis, but generally speaking, you are an LP equity investment shop whereby you invest on behalf of capital that you have raised. You leverage expertise with general partners, either real estate developers, owners, sponsors, and you create an entity, right? A venture. Can you maybe talk about how you see that venture, not only from, a sponsor's co-investment and what you guys are bringing to the table, but generally how that waterfall looks? Nothing specific, but generally how you see it.
Yeah, so I mean that venture, just kind of step back. I mean, generally we're either buying assets or developing. Generally, about a third of what we do is ground up development. But the other business plans, generally, at least on our opportunistic business, well, including the opportunity zone business, which is all development for the most part, they're generally very complex business plans, either full renovations, rehabs. I mean, we do a lot in the lodging space, so it's rebranding, and again, very, very heavy lift. So we're the 51 to 90% equity owner. Our partners have day-to-day control over the ventures, but we have kind of all the major decision rights in terms of sales, approving the sale of the property, the budgets, the debt financing, and the like. But we have our partners invest meaningful capital alongside us for alignment, and there's generally a preferred return, anywhere sort of 8 to 12%, depending upon the risk of the business plan. And then our operators get a promoted interest after that, so they get an excess piece of the upside if things go well, and the better the project does, the bigger piece that they get. So we are asking the those partners. Generally, if there's any kind of loan recourse obligations like repayment guarantees, things like that, that's provided by the operating partner and by our venture, but not by our funds. So it's kind of contained in that single LLC. And if there's a development orientation of the project, our partners are also giving some element of cost overrun protection as well to the entity. But so it's a series of so our funds are fully discretionary. So our investor base is a mix of actually, we've done a lot of sort of diversification of our LP base over the years. It started mostly on the high net worth side, and then we've kind of expanded to a number of sort of global wealth management firms that are investing in our funds and RIAs. And then the last couple of funds, we've kind of moved up to pension funds and endowments and foundations. And we have investors from predominantly US, but we have a number of investors also from Europe and Asia as well. But again, so it's a fully discretionary fund. We raise the capital from them, and then we invest that period over a period of 3 to 4 years into that fund, and that fund has a fund life of 10 to 12 years, after which we kind of harvest up to that point these particular joint venture investments.
And then just in general, you guys are, there's these funds, there's strategies in those funds too, because I know that you did get active in the opportunity zone marketplace. You have a hospitality vertical. I know you have a build for rent, you have multifamily, industrial. How do you kind of make the selections on assets and also kind of strategies? Do you do that an annual kind of thing, or how do you think about that?
It's at least annually. I mean, I think part of what we've been able to do over the years to be successful is to really be very strategic in how we invest by asset class, kind of by point in the market cycle. So we have historically been a lot in the rental housing business. I say in general, kind of rental housing, 50 to 60% of the business. But it started out mostly multifamily. It's since about 2018, we started, actually the first BTR deal that we did as a firm was with you in Las Vegas.
Yep.
And then we grew that business, very dramatically, and we're one of the bigger equity players in that space. Yep. And so we added that business. And so that's been, about half of our rental housing sort of component of the funds. But we, again, from like a sort of proven ability to kind of shift asset allocation in response to what's going on in the market. And our earlier funds were focused a lot on residential land. So we bought a lot of land off the banks that foreclosed post GFC, 2011 to 13, 14, we're really active there. That market really doesn't exist anymore in terms of buying distressed for sale land, because that market's pretty healthy. But we've avoided, for the most part, we do have some office assets, but it's a very small piece of our funds. Thank goodness. We're not big office owners, but we've done lodging, as you mentioned, over the time, mostly select service, extended stay, premium brands. We just always liked that lodging space in the lower middle market, because there's always lodging assets that aren't branded appropriately, aren't being run appropriately, non-institutional management. And a lot of our business on the value add side essentially is kind of straddling that institutional to non-institutional line, buying assets that aren't institutional, fixing them up and then selling them up into the institutional marketplace. So, which is, again, very good sort of lower middle market strategy. But we have also been good at sort of identifying what the next up and coming institutional asset is and get there first. Like we did with BTR, we've been doing it with iOS, industrial storage as well.
So the interesting thing is you guys you're always paying attention to where you're going, not just where we've been. But everybody who's been in this business is that I don't know anybody that doesn't have challenges, right? In the last couple of years, it's been a challenging environment for everyone to kind of work through. One thing I'd love the audience to understand is how does Argosy work with its partners to get through challenges? It's not, one thing I've noticed on this conversation is it's not about, well, we know, the deal we did together in Vegas, right? That was a fantastic deal. Worked out perfectly. Everyone made a bunch of money, but it's not always like that. So, it's about how, when times are tough, that you're really known, and what you think, how people are made of when times are difficult. And how have you worked on deals with your partners to get through some challenging situations?
Yeah. Well, even, that Las Vegas BTR deal, just for example, that turned out to be an extremely, big exit for everybody involved. And it was great. But that was in May of 2020, we were deciding whether to go vertical on the project. So we had done all of our horizontal work. And, of course, May of 2020, COVID had started, and I guess whenever it started, I guess it was really in sort of February, March timeframe where the lockdown and everything happened. So Las Vegas had about a 35% unemployment rate at that time when we were deciding whether to go vertical. And in hindsight, it sounded so easy to make that decision, and but when you had a 35% unemployment rate and you were just starting to draw on your construction loan, it was not the easiest decision. And we had, very good long conversations with our partner on that. And of course, decided to move forward, and thank goodness we did. But it wasn't a simple conversation from anyone's standpoint, including the lender who was involved in that, just to get comfortable that we were going to be drawing down on the loan. But again, that was different. COVID is, hopefully we don't have to go through that again, but that was a very unique point in time. But I think your question has to do kind of now, the last couple of years with the challenges in the market. Everyone's got challenged assets. And if they're saying they don't to you, then they're lying to you. If you're in the real estate business and you've been investing over the last, 4 years, you probably made a few investments that have some elements of challenges with them. And I think as a partner, you just have to be reasonable and thoughtful. And again, you're in a partnership with your operating partner. There's going to be good times. There's going to be bad times. And it's very rare for us. We've had, especially if you have what I touched on earlier about having alignment of interest with your partners and deal structure, that everyone should be, rowing the same direction. It's very rare, I think, for us ever to have a complete difference of opinion. I think we've had some instances where we had differences of opinion on when to sell an asset, which we've had once or twice, and we do have those controls. Or in some cases, we've kind of given our partners. We sort of converted our position from an equity to a pref equity position, like assuming a sale happens. We gave them some flexibility. Right. But we always try to work with our partners whenever possible, and in that instance, it was the right decision as a partnership to do it. But it's just being reasonable and logical, and being a partner. That's all I can really say.
Yeah. I think it's I've always said that if you are like hesitating when someone calls you, and this is not about it's like Match.com. I always tell people what I do for a living isn't always necessarily about the deal and it's like, do you get along with each other, and do you like to communicate? And I always say, if someone calls you and you're not excited or always going to be able to answer the phone call because you're like, oh, I don't want to talk to that person. I always tell them it's not a problem. It's just that those are people you probably shouldn't do a deal with. It's not that you just have a different personality. It's just, that's okay. But no question, communication is a really key. Yeah. I always think that that you never want to have somebody sweep under the rug. You always want to be open and transparent, and those are the really critical components of commercial real estate and investing. And that's really how the deal does get done. All right. So in that sense, you have these strategies, you have these sponsors, you have the verticals. You kind of think about it on an annual basis. You kind of know how to deal with challenges, but you also coast to coast. You guys are all across the country, and generally speaking, where are you seeing some of opportunities? But generally, talk about where you are investing. This is a national program. I'd love to kind of let people know where is Argosy putting dollars to work?
Sure. So we have 3 offices. So we have our Philadelphia office, which is the home office, is where all our back offices. We have an investment team and asset management team there. And then Andy's in Denver. He has investment and asset management team there too. And I'm in San Francisco. So we felt from the very beginning that it made sense to have 3 offices. Again, all real estate is local. You need to be able to react quickly and get there to deals. And if you're covering the entire country from one office, which in our business, a lot of times it's New York or Chicago, you just don't have the same sort of speed to market and market knowledge that we think our model provides.
Yep.
So we're I think that's not the easiest to manage when you've got 3 offices, but I think it's one of our biggest strengths is that we've been able to operate like that from the beginning of the firm and really be boots on the ground. Where we're focused now, so we've been like a lot of firms, we went more into the Sun Belt. So at the beginning of the funds, when we were coming out of the GFC, the earlier funds, we were less Sun Belt focused and more, I wouldn't say necessarily all gateway, but generally probably more kind of top 10 cities.
Sure.
Except New York. New York's not really a market we've ever invested in because it's not really a market where it's a lower middle market focused market because the check sizes are kind of too big. And if someone's raising money in New York, outside of New York for a deal, you got to have questions about it because there's so much capital already there. But we definitely shifted from those earlier funds to, let's say, like 15, on. We were generally more Sun Belt focused, and that was a very good move. I mean, we got there early, and we were rewarded for it. But we continue to invest there, and there are some challenges, as you know, with supply in some of those markets now, especially on the multifamily side,
Right.
where which we think will be, from a new investment standpoint, you're providing some interesting entry points because there's not going to be that much supply. I mean, the supply has been cut off, especially on a multifamily. Right. So 25, 26 would probably be great times to be starting new developments. So we think that, the Southeast, the Sun Belt, everyone is kind of beating on it right now, but you're seeing a lot of supply, but the supply numbers are historically high, record numbers in some cities. But if you look at it, there's been a lot of population growth in the last 30 years, but some of those are pretty eye-popping in terms of like percentage of supply that's being delivered. But you're seeing a lot of demand. I mean, still an incredible amount of demand, and it's just taking longer to get those leased up. But if you're not over leveraged, then you're going to be fine. But geographically, I am going back now, and we're looking at some, especially on the West Coast, looking back at some of these markets that have been Portland, Seattle, being based in the Bay Area. You have to kind of look here. There hasn't really been a lot of distress in the Bay Area except office and downtown SF and Oakland, pretty much everywhere. There's distress in the office world, but we're selectively looking back into those cities. I mean, there's no supply in any of those cities, which is a good thing. But they also have their other challenges that are keeping people away. Law and order types of situations and homelessness,
ownership rights, and things of that nature.
Yeah,
which we can. That's we'll use that as another. That's another one we'll talk about in the future.
Yeah.
I think just in general though, we're talking about some things that geographic and but the cycle. I do want to kind of end our conversation today on where we see things in the cycle. We're in a cyclical business. Generally speaking, we've seen assets fall in value. Obviously office has significantly fallen in value. Cap rates have skyrocketed. It's a challenging time. Rents have flattened, expenses are up, and the like. And so, where are we in the cycle of things? And how offensive will you be Are you still, obviously, I think we're still defensive in certain things, but are we getting there? I guess I'd love to understand Argosy's thoughts about where we sit today in the cycle.
So it's hard to say if you're at the bottom or not. I mean, there are some, groups that are saying we're at the bottom, but either way, it feels like we're close to the bottom. I mean, sure, if it goes down a little bit more, did you time it perfectly? If you went now and it fell 5% more, is that still a bad investment that you missed the absolute bottom? No one's going to be able to call the absolute bottom. But we think 25 and 26 are going to be good investment vintage years, because you'll start to see more transaction volume. We're all just not seeing a lot of volume here, and peak vintage returns for funds. Generally, if you look historically back, are kind of 2 to 3 years after that dislocation. Which in this one, dislocation was kind of mid 22, the rapid rise in rates. Yep. So we feel like it's a good time to be in the market, looking for new investments. I think especially kind of in our segment of the market, kind of the more non-institutional ownership, perhaps a little more highly leveraged, where we'd be buying from. But I mean, I kind of look at, like you say, like cycle. You got to kind of look at different past downturns, right? And you look, okay, well, is this like the GFC? Well, in some ways, it's like the GFC, but the GFC was a for sale housing market caused downturn, which was so massive, and that element of the market is so pervasive across everything, which really had very drastic effects in the economy. The commercial market, yes, it's been bad, but it's not as large as the residential market, the for sale residential market. So there's some semblance of that, but then you look at like, well, is it like the RTC SNL crisis time period, right? That's the next one you look back.
Yeah.
Well, actually, probably look back in our careers would probably be the .com. That was a more of a regional real estate problem, and actually that was office driven too. But you had all the .com companies go out of business, and you had a lot of office vacancy. Here, they're not going out of business; they're just not going back to the office. But it's different. But it's in the RTC, you just had this huge, massive amount of supply, which you have in some markets, but overall in the U.S., there's not a massive supply problem, especially in housing. You're probably anywhere 2 to 5 million housing units short, depending on who you talk to. But in the RTC, heading up to that, you had these massive tax-driven strategies that people were building way over building, and here we don't have that. So every cycle is different, but this one is potentially very attractive. Anytime prices are down 25, 30% from the peak, that's at least sort of Green Street sort of Odyssey weighted number.
I mean, I think it's pretty safe to say that most assets are down 20 to 30%, and office is down 50%. And so the reality is we're trying to kind of work through that, or at least unleased office is down 50%. If it's leased, so.
You also have a lot more, when you talk about cycles, you have a lot more equity that's in the market this time than you did coming out of the GFC. Very few people had funds raised going into the GFC that were ready to deploy. And this time you have a lot of capital. I think it's very concentrated. I mean, if you look at the capital that's been raised, and that's why we like the lower middle market now, is the majority of capital is raised by the big funds. Right. So I think the average closed fund last year was close to $2 billion in the U.S., and 2/3 of it almost was raised by 4 managers only.
Right.
So there's a lot of money out there, but I think it's in the mid market where we like to be. There's less. Not to say that there's not money. There's just less competitive versus the larger scale.
I totally agree. And then when you sell the assets that you're investing in, you're traditionally selling to an institutional buyer, and so you kind of took a more illiquid asset opportunity and selling it into a liquid buyer pool. But I think the one thing we'll just probably leave with is that there's no no doubt in my mind that liquidity is there. It's
Mhm.
just about functionally investing, because we're trying to figure out where the basis is, and then we bottoming. Are we investing in the right asset class in the right markets? Compared to the GFC, I feel like it's a different in that regard. There was no cash then. It just felt like everything just dried up and everything was done.
Yeah.
And we were toasted at that point. But
Yeah, and the lending market now is, I mean, you can say it's bad. I mean, the regional banks, especially, right? A lot of them are out of the market or severely reduced their volumes. But there is actually a lot of lending out there. It's just people don't want to pay the rates that are there. I mean, the debt funds.
No question that the winners right now are on the lending side.
Yeah. Yeah.
All right, Dave. Well, listen, I gotta get back to work. It's before holiday week. Can't thank you enough for coming, and really excited. If anybody wants to reach Dave, just feel free to reach out to us. We'll put you guys in touch. But Dave, thanks again, my friend, and thanks for having another edition of On the Edge, where CRE deals get done. Thanks so much, Dave.
All right. Thank you, Malcolm.
All right, buddy. See ya.
Bye.
Thanks for taking the time to tune into our latest show. As always, you can find us through our YouTube channel at youtube.com/@wayontheedge or at our website at www.waycapital.com. Until next time, keep working on the edge.